Welcome back to the channel. Today, I wanted to speak on something a little controversial and outline why I believe stock price doesn't matter. Before you run away screaming that I'm an idiot, please give me a couple minutes of your time to explain myself. If at the end of the video you still think I'm an idiot, please use the comment section down below to let me know why you believe that. Since my time is ticking, let's find out why stock price might not matter as much as you think.
I'll give you 5 minutes.
First, let me quickly outline the reasons why I hate seeing people wait for the perfect price. Far too often, investors will set these numbers up in their head that are nice round numbers and state when a stock hits $70 per share, I'll buy it. The issue with that is twofold. First, there's no guarantee that the stock will ever reach that price. And in the meantime, your cash is sitting there waiting for that opportunity, missing out on possible stock appreciation and dividends, and not to mention losing value to inflation. Let's quickly look at this example. It's January 4th, 2019, and you have $500 burning a hole in your pocket, but since you're a responsible adult, you're looking at Apple stock at $37.07 per share. You check the charts to see that just 3 short months ago, on August 31st, 2018, it was sitting at $56.91 per share. And even though you have been dying to scoop up some shares of Apple, the steep 34.86% drop in the last 3 months has you a little uneasy, so you hold off because you hear from the quote-unquote experts that the stock could keep falling. Because the experts know nothing, over the next 4 months, the stock rises 42.81% up to $52.94 per share. Well, according to the experts, now it's simply overvalued and you need to wait for the next drop. You really want it around that price that it was at the start of the year, now that you know what you're doing, so you set your buy point for $37 per share. Less than 30 days later, on May 31st, the stock has fallen 17.32% because of course the experts know their stuff, and the stock now sits at $43.77 per share. You get excited because this is now just $6.77 away from that $37 price target you just set a month ago, and you can smell the money, but since $43.77 per share is still higher than the $37 per share you want, you still hold off. Throughout the rest of the year, the stock proceeds to go up 69.89% to $74.36 per share. You realized you missed the boat and you cry yourself to sleep. Over the next 6 weeks, the stock continues to trend upward another 9.25% to $81.24 per share, and you think for sure you missed the boat and start to have FOMO. You then decide to fold and finally spend that $500 you had specifically set aside for Apple and purchase 6.154603644 shares at $81.24 per share on February 14th, 2020. Because timing the market always seems to be a losing battle, COVID happens and Apple drops 29.49% to $57.31 per share on March 20th, 2020. Now that doesn't spook you enough to sell your 6+ shares, but it does spook you enough to hold off on buying until things blow over. This story illustrates how waiting for a certain stock price can cause you to miss on significant gains, and how trying to time the market is often a losing battle. By taking advantage of fractional shares and dollar cost averaging into high quality companies like Apple, you can build a great portfolio without getting bogged down by the fluctuations of the market and the emotions they cause. To drive this point home, I wanted to show you the following. During that story, I outlined 5 different events and periods of time: January 4th, 2019, May 3rd, 2019, May 31st, 2019, January 3rd of 2020, and February 14th of 2020. If that person would have split their $500 up and just bought every time they looked at or thought about Apple, they would have fared way better than waiting for the perfect time, which never came. I want to quickly show you the numbers for 3 different outcomes to back that up. So person 1 likes to use fractional shares and they dollar cost average. This person in the same situation would have had 9.446929633 shares at a cost basis of $52.93 per share. As of April 21st, 2023, the stock price for 1 share of Apple cost $165.02, which means today's value for their $500 would have been $1,558.93, which gives them a $1,058.93 return, which is 211.79% total returns, 42.98% year-over-year returns over the past 3.181 years. Person 2 is the one that's in the story I just told you, and that person we're going to call the FOMO person. Person 2 still ended up with 6.1546 0.03644 shares at a cost basis of $81.24 per share. Again, that April 21st, 2023 stock price for Apple is $165.02 per share, which means person number two's $500 is now worth $1,015.63, which gives them returns of $515.63, which is a 103.13% total return and a 24.96% year-over-year return, again over the past 3.181 years. And person three that's waiting for the perfect price, well, they still have $500. Despite all the studies that can be found on the internet talking about how lump sum investing is better than dollar cost averaging, there are other things to consider that I believe swing the scale to the side of dollar cost averaging. First, there are a lot of emotional waves to ride as an investor, some for the good and some for the not so good.
I'm in a glass case of emotion.
This can truly impact your plans when it comes to spending your hard-earned money on a stock that might be a little bit more volatile than you can stomach. Second, trying to pinpoint the best time to buy a stock can be nearly impossible.
Understanding that that's damn near impossible.
As you saw in my story example, if you are able to get over the emotions of the stock market, you then must decide if that current price is low enough or if you want it to go lower before buying, which brings me to my last point. The stock might never hit your quote unquote perfect price. I've heard from several different people that I'm in groups with that miss their opportunities to buy quality companies like Apple, Microsoft, Costco, and many others because the stock never hit their target price. While they still made money in other places, they're still kicking themselves for missing their buying opportunity in these companies, sometimes by less than $1. I truly believe that if you identify a solid company and have the cash to invest, pulling the trigger and adding additional cash as you have it will always end up winning in the end.
Well, I'm definitely in.
With that being said, please let me know in the comments if you're team dollar cost average or team lump sum, but be sure to dollar cost average that like button by turning it blue and subscribe and ring the bell for fresh dividend related content weekly. If you missed it, I just did a video outlining one of the best free resources in the game of dividend investing in the CCC list. I'm going to link that right here, but until next time, see ya.